Hey everybody, Mark Kelly from University Financial Strategies. So obviously right now we're dealing with the effects of the coronavirus and it's having a negative impact or creating a lot of volatility in the stock market. And so I wanted to just give you some information to help you in terms of getting through this period of time. And because I believe the more information you know about your investments, the better off you're going to be in the long term. Um, so, many times what I've seen is that I've had people that the markets are selling off and they want to do something. And so, especially in very volatile times. And so a lot of times, we may want to make some portfolio reallocations, but I wouldn't say we want to make wholesale changes to what you're doing. I remember personally, going back in 2009. So it was in March. It was March 9th of 2009. I remember being at my daughter's soccer game, and I was talking to one of the other parents, and the parent said to me, "I had enough. I can't deal with it anymore." And so they said they sold completely out of their portfolio. Okay. The problem was that was the day that the market was at its lowest valuation during the credit crisis. So 2008, 2009 was the bottom line. That was the worst time to sell for them, and so I always remember that because I think you can use that to think about the future. I've been in the business almost 3 decades now, and I've seen more things. You see the .com period, you see the credit crisis. There's always something, but this is just a way to reflect and kind of compare against the coronavirus. But this is something that that Vanguard had put out. Obviously, there's no guarantee that the market will play out the same as it did for the SARS sell-off or the Zika sell-off. But I think it's good information to give you some perspective. Okay, so if you look at the 2003 SARS sell-off, here you're seeing that the portfolio went down, and so we had a sell-off. Okay, but then here we're returning to the peak, and that's just about about 1/4 of time between the peak, the peak of the market, and then when it sell off and came back. If I look at Zika sell-off, it was very similar, and so the lesson learned is really to have a strategy for how to get through that. And that's kind of why University Financial Strategies actually uses what we call a risk number. So many of my clients know that I use a portfolio that is customized for you, because we know that it's usually emotions that have an impact on your investments. And that's why the average investor usually underperforms, is because their emotions are telling them to do something that may or may not make much sense. Okay. I did want to give you some understanding about the math as well behind losses, and really tie into why we use that quantitative approach, because we're really trying to develop a portfolio that's not only going to grow for you on the upside, but also is going to try to manage the volatility, or we say on the downside risk. We want to make sure we're managing for that as well. And it's because of the math. So oftentimes you'll hear, I'll ask clients, okay, well, if your portfolio goes up 50% one year and then goes down 50%, what's happened to your portfolio? And what I usually find is that most clients will come to me and says, "Oh, I'm up 50% one year, down 50%. That means I'm even." Well, there's a problem with that. That's not how the math works. So if we look in terms of a dollar amount, okay. So for example, we say we have a $100,000 portfolio. It goes up 50% one year. Well, it's going to go up to $150,000, right? So if from there it goes down 50%, well, 50% of 150 is what? It's 75,000. So as you can see, the math there isn't quite the way you think it is, and so that's just very normal. And so I wanted to help you understand that that's the dynamics behind it, because we want to ultimately try to manage that downside and make sure that we're having consistent return, or what we say is kind of like the tortoise versus the hare approach, because I think ultimately we want to try to be consistent as opposed to being occasionally great. And in that approach, we think will help you try to fund your goals. So as a financial planning firm, That's what we're really about, is trying to make sure that we're funding your goals, whether it be for retirement or for college savings or whatever it be. If you would like to talk further about it, feel free to give me a call, 909-391-7526. And you can also book a appointment on my website at universityfinancialstrategies.com. Thank you.